Good morning to those of you who are joining from the Pacific time zone, and good afternoon to those of you who are joining from points east. Would like to get started promptly in order to be respectful of everybody's time. Just a quick housekeeping matter. In view of the fact that we're going to have a lot of participants, it's going to be really challenging to undertake live Q&A during the pendency of the webinar this morning. And so as a result, it'd be terrific if you have any questions or comment, feel free to email me or to call. For those of you on the call this morning that don't know me, briefly, I spent a number of years co-managing a large special situation hedge fund that invested literally in hundreds of small cap financings, in other words, for public companies. Subsequent to that, for the last 7 years, I've been acting as an advisor to CEOs and boards of pre-IPO companies as well as small cap public companies. In addition to advising lots of companies, I spend time almost every month traveling both nationally and internationally, speaking at corporate governance events and also at investor conferences. As you would imagine, I speak to an awful lot of CEOs, not only in an advisory context and also from my days as an institutional investor, but also as a speaker. And from my experience, I would really put the CEOs with whom I interact into two different buckets, if you will. The first are a group of CEOs that I would characterize as being fairly skeptical of the value of fulsome corporate governance. The other bucket, and if you were to figure out a way to graphically illustrate that, it might look something like this. Some of you probably have been in boardrooms like this. I certainly have. But that's the viewpoint, if you will, of some of the CEOs with respect to corporate governance. In so many words, I've heard CEOs, for example, say, it seems like it's much ado about nothing. I don't understand why institutional investors are so wound up about it. Moreover, in my experience, it's more of a form over substance kind of waste of time. That's kind of one camp of CEOs. The other camp of CEOs with whom I regularly interact don't believe that at all. They feel as if what goes on in their boardrooms when they're the CEO and also other boardrooms where they might be on the board is incredibly important to shareholders. But I also find that primarily because a lot of them perhaps have not undertaken continuing education or any type of formal governance training, that there's an awful lot of repetitive questions that I get asked from those CEOs. Questions like, for example, who should be on the board of our company? Almost as importantly, who should not be on the boards of our company? What's really the role ultimately of board members? And also trying to get information, and here's, I think, part of the key issue for a lot of the questions and what the questions keep coming back to is a lot of the information they get is really kind of 50,000 foot level and or kind of academically oriented as opposed to more practical and implementable. So the goal this morning is to kind of split the webinar into two sections. The first section is going to be talk about situations that are plucked right from the news. Again, this is not going to be an academic discussion and or a discussion at 50,000 feet. These are situations plucked right out of the news of companies where boards either were really impactful to the upside or the downside for shareholders of those companies. And then the second half of the webinar is going to be to try and take on a number of those repetitive questions, and again, in a very practical, implementable way. And at the end, try and present a case study or hypothetical to show how all these things kind of coalesce to either go well or to go poorly. So with that, let's get started with a look at a few different companies. Some of you may know all of the companies. Some of you may not know them, but let's get started. So the first company is a company that I'm sure virtually everyone on the call this morning knows. Lehman Brothers, of course, merchant bank that was founded way back in the 1850s and dissolved and went bankrupt during the financial crisis. Now, without getting too much into the weeds of what happened to Lehman Brothers, again, Lehman Brothers was a merchant bank. One of the things they started doing in the years leading up to the financial crisis was increasingly relying on sophisticated and highly complex financial instruments in order to drive value for the shareholders. Some of you may recall some of the movies that were made about it, and the constant discussions from people like Warren Buffett and others about these derivative instruments that were used to make bets, for example, on the housing market, among other markets. And so, for our purposes this morning, what's important to take away from Lehman Brothers was that what they were increasingly involved in was hyper-sophisticated financial instruments. And when you look at, there's been a lot of studies of Lehman Brothers after the fact, and one of the things that's on the slide here is from Stanford University. When they conducted their post-mortem, quote-unquote, what they found, as did, mind you, lots of others, is, gee, it sure seems that for a company that was engaged in hyper-sophisticated financial instruments, that you would expect to see people on the board of this company with that type of experience, right? It makes sense. Yet, when you look at the board composition of Lehman Brothers, what you see is CEOs of lots of different companies. Very few of them, by the way, are financially related. You see a retired McKinsey consultant, and then you see military people, you see a theater producer, an actress. And so what you see there is seemingly at a very high level, kind of a disconnect between what you would expect to see on the board of a company like Lehman Brothers and these board members. And why does it matter, again, at a low elevation? Well, I would argue, as have a lot of others, that, gee, it sure seems like it's really challenging for this group of board members to really understand the risks that they were facing on the balance sheet of Lehman Brothers. And again, from the perspective of an institutional investor, the question that any institutional investor would ask is, it's pretty challenging for board members to manage risks that they don't understand. And so Lehman Brothers stands, I think, alone as an example of what happens when you have a mismatch of skill sets in the boardroom. If you carry that forward a little bit from 2005, 6, 7 up to very recently, in fact, last year, you come to a company called Zenefits. Some of you may recall Zenefits is a human resources software company. One of the things that they were focused on is trying to make things easier for people that were presiding over the human resources function at enterprise level companies. One of the things, of course, some of you may have your own experience as human resource experts, but one of the things that's really challenging in today's ecosystem is for HR people to navigate, among other things, health insurance. So what they were trying to do and focus on was provide a mechanism for human resources folks within enterprise level companies to be able to more seamlessly and efficiently go out and purchase health insurance. Health insurance, of course, is a hyper-regulated industry on a state-by-state level, a labyrinth of statutes, very challenging to become expert in that from 0 miles an hour. At the time that the founder of the company, Parker Conrad, resigned in February of 2016, this company, notwithstanding the fact that it was a private company, was a pretty substantive company. The company had already raised about $500 million with a B and was valued at nearly $5 billion. So by any measure, this was a substantive size company, notwithstanding the fact that it was privately held. The company ran into problems. Some of you may remember reading about them. In addition to some cultural problems in the company, they also ended up getting in trouble with a lot of state regulators where they paid fines in multiple states for ostensibly, from what I could tell as a non-insurance expert, seems like they got in trouble for selling insurance without a license. Now, I don't want to talk about the company in past tense. The company is still going. I hope, like as does any other American, that if whatever they're doing is ethical and legal, that they continue to stay in business for their employees and for their customers. But for our purposes today, it's important to note that the valuation of the company, according to a lot of people here in the Silicon Valley ecosystem, has probably been halved as a result of some of their challenges. And I said here, a little bit euphemistically, admittedly, calling Zenefits Lehman Brothers Part 2. Why did I do that? Well, when you look at the board of this company, at the time that Parker Conrad resigned in February of 2016, you see something really interesting and poignant as we think back to the conversation about Lehman Brothers just a minute ago. There were 4 board members. Now, reason people differ as to whether a $5 billion valuation company can be presided over expertly by 4 board members, but there were 4 board members. 3 of them were insiders, meaning they were executives at the company. Now, one of the things that we're going to talk about as far as some of the core functionality of a board, one of the basics of governance is that board members are seated in order to oversee management on behalf of shareholders. So pretty challenging when 3/4 of the board are insiders, because just in a playground sense, it's awfully difficult to oversee yourself. So there were 3 insiders, and there was 1 outside director. The outside director was from the venture capital firm that was a large investor in the company. Well, interestingly, when you look at the 4 different board members, 0 of them had any experience whatsoever in the insurance industry. And as we talked about a moment ago, insurance is a hyper-regulated business. And of course, the story that we wouldn't be talking about Zenefits had it not been in the news every day for paying fines in multiple states for violating insurance regulations. So similar to Lehman Brothers, where the board members found it really challenging to oversee risks that were outside of their expertise, this board clearly had a hard time overseeing the risks associated with the insurance business, I would argue in point, because none of them had any insurance industry experience. The third company I think worth talking about for a few minutes this morning is Theranos. Some of you may remember reading about the extensive research and reporting in the Wall Street Journal about Theranos. Theranos ostensibly is a medical device company that sought to really upend, if you will, the blood testing business. They were going to create a machine that, rather than taking lots of blood out of your arm, this machine would take a pinprick sample of blood from the tip of your finger, analyze it fairly quickly, much more cost effectively, and completely revolutionize the phlebotomy business. Now, you can argue it, and here you don't need to be a science expert, and you can use whatever nomenclature you want, but whether it's biochemistry, whether it's pathology, whether it's medical devices, whether it's epidemiology, whatever words you want to use, this was a sophisticated medical technology company. And similar to the fact patterns of not only Lehman Brothers, but also in Zenefits, when you take a look at the board of this company, which now is a shadow of itself, has fired most of their employees, got in trouble with all kinds of regulators for perhaps misleading their shareholders, and also perhaps not having the technology that they represented to corporate partners as well as to the public. When you look at the board members, you would expect to see, in a highly advanced company involved with, again, biochemistry, pathology, etc., you would expect to see an awful lot of science people on a board like that. Well, what you do find when you look at their board are 2 former secretaries of state, 2 former senators, a former secretary of defense, a retired Navy admiral, Marine general, former retired CEO of Wells Fargo and also of Bechtel, and then a retired epidemiologist. And one of the former senators as well was a doctor. But people have joked about the fact that Theranos' board was arguably more well suited to go to war than they were preside over a sophisticated biochemistry company. So again, when you look at Lehman Brothers, when you look at Zenefits, when you look at Theranos, you see a pattern, which is companies that perform really poorly, and you have boards that appear to be really inappropriately comprised to deal with a lot of the key enterprise risks that those companies face. Now, I've been asked a number of times when I speak about these companies, hey, you could have just gone out, Adam, and found companies that failed and then gone to look for egregious examples of companies where the boards were really poorly comprised, and you're extrapolating that now on behalf of, under this guise of the fact that institutional investors are right to focus on corporate governance and that it's critical to shareholders, and that may be a false corollary. And I think it's a fair point. In fairness to myself and to you, I'll just let everybody know I definitely did not go and look for companies that failed and also to find boards that were poorly comprised. But it's a fair argument. And those of you who have taken statistics, false corollaries are everywhere when people are trying to make points. And so as a result, I want to talk about the next company, which makes the false corollary point perhaps not terribly compelling for our discussion this morning. And that company is Darden Restaurants. Some of you may have heard of Darden Restaurants. Darden Restaurants is a New York Stock Exchange listed company. Darden owns, among other companies, Olive Garden restaurants. When you look back 5, 6, 7 years, sales in the 2011 timeframe, about $7 billion. You look several years after that, the sales had sunk on a real basis and on a percentage basis pretty dramatically down to $6.2 billion. And it's worth noting that during the pendency of that sales decline, the peer group that Darden competes against in the casual fine dining group, their sales had gone up during that period. So they are underperforming their peer group during that period pretty meaningfully. The stock price, not surprisingly, during that period, 2012, 13, 14, fairly range bound, stuck within a $40 to $50 range. In 2013, for example, I mentioned earlier that they underperformed their peers, but meaningfully, the company also was underperforming the S&P by a material margin as well. And so the measures that you look at to see whether a company is performing well or poorly, how are they performing against the overall stock market indices? How are they performing against their peers? This company is not performing well. 2014, an activist investor called Starboard enters the scene. They buy some stock in the open market. They begin to make presentations at investor conferences talking about the fact that this company is poorly run, and for our purposes today, it's also poorly governed. And they laid out for the management team and for the board a number of initiatives, among which was, we believe that you should replace every single board member on your board with the slate that we're recommending, people that are much better suited than the board members who are currently seated. Management team and the board discussed it. They came back and said, we're not going to do those things. A proxy contest ensued, and then something happened that very rarely happens in corporate America. And what happened was Starboard won. And for our purposes this morning, what's important to talk about when I say that they won is that every single board member was replaced. So you can point to a moment in time in their stock chart and then in their corporate continuum and say, this is the moment where an entirely new board got seated. And so instructively, now we're several years hence from that, you see a number of pretty interesting developments, right? You have a company that's performing resolutely poorly for a number of years leading up to that moment, as I characterize it, when an entirely new board is seated. When you look at the period after, you see that, well, revenues climbed back above $7 billion from $6.2 billion, which was probably the low point during the period of time that we're talking about. Net income from continuing operations has more than doubled during that period of time. And this morning, before we started, I looked at the stock price. The stock price has more than doubled to about $90. And not only has the stock price doubled, but the company also, shortly after the new board was seated, the company spun off some real estate that they had into another public company, and that company now has a valuation of more than $1.5 billion. So by virtually every measure, since that line in the sand, if you will, when the new board members came in, the company has been performing dramatically better. So, we can talk about the possibility of false corollaries and pointing to other failed companies and then looking at their board composition. I would argue, by the way, that the companies that we talked about, Lehman Brothers, Zenefits, and Theranos, that those are not false corollaries at all. But to those of you who might harbor some skepticism about that, the reality is it's incredibly hard. It is incredibly hard to look at Darden restaurants and look at a brand new board being seated, look at the performance after that board was seated, and continue to maintain that that board has not been astonishingly impactful on this company on behalf of shareholders. I mentioned a moment ago that, and just to graphically kind of drive some of these points, I mentioned that Darden, in the period leading up to Starboard coming on board, that Darden was really underperforming its peers. And here's a pretty compelling graphic representation of that. The line, the lowest line on the graph that oscillates below 0% is Darden Restaurants in the blue, and the other casual fine dining peers are the ones that are north of that line in a pretty tight grouping. So pretty clear to see here that again, by any measure, Darden was really underperforming its peers, as well as I said earlier, the broader stock indices. But then you look subsequent, and this doesn't go up to the present moment. I'm guessing that if we had one that went up to the present moment, these lines actually at the far right end would be even further. What this line is what this graph, pardon me, is reflecting. The blue line is Darden Restaurants. The yellow line represents, in the aggregate, the peer companies. And that, when you look at the price to earning multiples, the valuations of those companies, Darden Restaurants is being valued much higher on a percentage basis, and I would argue also in real terms, than the peer group. So again, by any measure, the impact of that board and also the management team has been material. But it's not just some of the things taken from corporate news, i.e. the companies that we talked about, Lehman Brothers, Zenefits, Theranos, and Darden Restaurants. There have been some other initiatives that have gone on in the last couple of years that I think are worth talking about. Again, particularly with respect to CEOs that are skeptical of the value of fulsome corporate governance and efficacious boardrooms. And what do I mean by that? Well, some of you might recall that in July of last year, almost a year ago, that this group of people, among others, and this group, of course, Jeff Immelt, Warren Buffett, Mary Barra, Jamie Dimon, among others, took out full-page ads in the New York Times and the Wall Street Journal imploring not just public companies or large public companies, but small public companies, large public companies, and small private companies and large private companies to really embrace governance best practices. And when you read between the lines of what those principles are, to me, it was pretty basic. And really what this group of people, and there were others that were behind the common sense governance principles, what this group was admonishing corporate owners, whether again they're large or small or private or public, is simply comes down to this. This group believes that better governed companies make more money. Okay? That's the reason why this group of industry titans spent time and effort admonishing companies all around the United States to really embrace corporate governance best practices. And that's pretty poignant. There really isn't a lot of other instances, certainly in my career, where I can recall a group of industry titans getting together and literally, or in this case figuratively, banging the table, telling companies of all different shapes and sizes that corporate governance matters. And again, in so many words, that we know, we're not suspecting, we know that better governed companies make more money. Okay? And it's not just some of the things taken out of the news with respect to companies. It's not just industry titans like this, but it's also institutional investors. Larry Fink, who's the CEO of BlackRock. BlackRock, of course, is the largest asset manager on earth with many, many trillions, with a T, trillions of dollars under management. In Mr. Fink's letter to shareholders last year, and he repeated some of this again in a subsequent letter, he also implored all of the portfolio companies of BlackRock to undertake the best practices possible in boardrooms, and really was espousing the same view, right? Because there is no entity on earth that is more for-profit, arguably, than BlackRock. And BlackRock would not have lots of corporate governance analysts and be writing letters imploring everybody to focus on corporate governance if they didn't know 100% that better governed companies make more money. But one of the things that they said, that Larry Fink said in his shareholder letter is encapsulated in what I took out here as an excerpt. And that is that boards not only have to be properly comprised, but they have to engage in a robust debate. There should be a really rigorous process where the board goes back and forth with management to determine whether strategy is the right strategy for the company, and then it's up to the management team to undertake a tactical approach to effectuate that strategy. But really what Larry Fink is talking about here is that this process has to be rigorous and there needs to be a robust debate. Well, if you think back to Lehman Brothers, for example, pretty challenging for there to have been too terribly much of a rigorous debate when none of those board members really could have had an innate understanding or been expert in highly complex derivative instruments. Right? Pretty challenging to have a robust debate about things that you're not an expert in. Right? So I would argue that when you look at now we're looking at a large institutional investors. There's other similar letters out there on behalf of people like CalPERS and CalSTRS, state of Wisconsin, all kind of other large institutional owners. It's not just this group of long bias institutional investors. It's not just industry titans though, and it's not just things that you take out of the news every day. There's also a $200 billion industry of shareholder activists. And interestingly, Wall Street Journal, Bloomberg, CNBC focus predominantly on a small number of shareholder activists, predominantly on folks like Carl Icahn, Nelson Peltz, Bill Ackman. And so if all you did was read the Wall Street Journal or watch Bloomberg or CNBC, you could easily be cajoled into thinking that shareholder activism in this giant $200 billion industry is pretty much exclusively focused on large public companies, because that's the only thing that gets covered in the news. In reality, for example, in 2016, 73% of all the shareholder activist campaigns in the United States were undertaken in small cap companies with market caps below just $2 billion. Right? And so when you think about the ecosystem that we're talking about, not only the pre-IPO ecosystem, but also the small cap ecosystem, where I do all of my writing, speaking, and advisory work about, what's clear from this industry is that shareholder activists are not happy with corporate governance in small cap companies, and there's an awful lot of people, time, energy, money focused on trying to fix that, because make no mistake, the overwhelming majority of shareholder activist campaigns are actually focused on boardroom changes. Okay, so I think to those CEOs who their feeling is they're still kind of on the fence and there's still some skepticism about the value of fulsome governance, when you look at some of the things that are taken right out of the news, when you look at some of the dispositions, if you will, of well-known industry leaders, when you look at large asset managers, when you look at shareholder activists, they're on the other side of the table on this argument. And so I would respectfully ask the following question, which is, why are all these industry titans and why are people that manage trillions of dollars, why do all of those people think and take out ads to tell everybody that better governed companies make more money if corporate governance is really is represented by that first graphic that I showed of people throwing paper airplanes and not being very helpful inside of a corporate boardroom, right? Pretty hard to square those things, right? And so I think that this disconnect out there in the capital markets is a real one. It's a poignant one. It's one that I come up against all the time with CEOs and board members that I meet at speaking events and also advise all around the world. And I think it's a fair question and worth just a minute to talk about, how did we get here? How did we get to this point where there really seems to be a material disconnect of the part of the marketplace that feels that the value of corporate governance may not be all it's cracked up to be, and then on the other side of the table, there are people who manage trillions of dollars and industry titans pounding the table and all the news headlines on the exact opposite of that argument. And I think one thing that just needs to be said, I think, frankly, from a practical standpoint, is that there's an awful lot of founders and CEOs that just don't revel in oversight. These are people that are running fast, they're innovating, they're trying to upend industries, and they just don't simply revel in oversight. And so I think that there's a lot of academic disagreement about governance. There's lots of disagreement about various different aspects of best practices. But it seems to me that it would be great to just level set and say, look, there are an awful lot of CEOs and founders, whether it's the pre-IPO world or whether it's a small cap world, that just don't really want anybody overseeing what they're doing because they're kind of getting in the way, quote unquote. And I hear that all the time, by the way, from CEOs. And I think that in order to make this discourse a little bit more level-headed, let's just all just say that out loud, right? There's an awful lot of CEOs that just don't want any oversight, right? They view boards as just getting in the way, form over substance, waste of time. The second aspect to this, and I won't belabor this, and before I say something about lawyers, I started my career as a lawyer at a giant law firm, so although I don't practice law anymore, I might be able to play one on television. But I think that we've done a bad we've done a bad job in the United States in talking about corporate governance. All you have to do is mention that at any investor conference that the next panel discussion is going to be about corporate governance, and you can just tell the look on people's faces. That's either the panel that everyone has circled on their agenda to go get coffee, to go meet their friends, to check their email. When you say the word corporate governance, most people's eyes are going to glaze over. And I think part of the reason for that is that whenever corporate governance is discussed, there's kind of a rote, lawyerly monologue about sometimes inane aspects and minutia of Delaware law, and most of the people in the audience are not lawyers. So while a lot of what the lawyers are talking about is, of course, important, it's easy to conflate, if you're not that astute or not that experienced with corporate governance, that corporate governance equals these lawyerly monologues that can virtually put any non-lawyer to sleep in a matter of minutes. And the reality is, you can talk about governance for hours and hours and hours and hours and never mention anything having to do with Delaware law, never mention anything having to do with law, period. Okay? And those are the reasons, by the way, that institutional investors are so focused on boardrooms. Not because of the aspects of Delaware law. It's the other way around. Okay? And so I think that we've done a bad job of that. And that's the reason why when you use the word corporate governance, people's eyes just glaze over. The last bullet point here, I'm not going to make a lot. I'm happy to speak about this offline to folks, but especially because the leaders of tomorrow, today, are ensconced in the pre-IPO kind of venture-backed ecosystem. Venture capital firms also need to materially update their thinking and their practices when it comes to corporate governance. The reality is, in what we refer to here in Silicon Valley is the Sand Hill Road ecosystem. Sand Hill Road is where all the venture capital firms are located, or certainly a lot of them. In the Sand Hill Road ecosystem, the thinking around board composition probably hasn't changed meaningfully since literally the 1970s, notwithstanding absolutely Herculean changes to the capital market since then. So I think that there's some reasons for how we got here. I think it makes sense to speak about them practically because it helps solve problems. And so with that, let's move on to talk about the second part of the webinar, which is getting at some of the frank, practical, implementable takeaways to questions that I get asked over and over and over again by the CEOs who are not necessarily skeptical, but really perhaps haven't had a lot of continuing education when it comes to corporate governance, or they just still have questions based on their own experience as board members and as CEOs. And the first one, believe it or not, it's not just pre-IPO earlier stage CEOs that ask me this question. There's an awful lot of much more seasoned public company CEOs that actually aren't terribly clear, and by the way, also board members that aren't actually terribly clear exactly what the role of a board is. So again, I promised that we weren't going to talk about anything legal, and I'm going to stick to that. But you know, the easiest way to go through some of these things is just kind of fairly quickly in rapid succession, which is, you know, a board's primary role is not to mentor the CEO. It's not the primary role of a board of directors. A board's primary role is not to make business introductions. Okay? That's not the primary role of a board of directors. And a board's, and the third one is something that in the pre-IPO ecosystem is something that that people always kind of chuckle about when I say it, which is that a board's primary role also isn't to look impressive to help valuation, although, you know, nice try. But a board's primary role is to objectively oversee management on behalf of shareholders. That's a board's primary role. If a board, in so doing, also happens to help mentor the CEO, help make business introductions, also help, by the way, with valuation, terrific. But a board's primary role is to objectively oversee management for all the shareholders. And again, that sounds very basic to some of you on the call, but again, I hear from CEOs over and over again, and one thing that's really clear to me when I'm talking to them and some board members is I'm not so certain that they understand the difference between what a board's primary role is and what a secondary role might be. A board's other primary role, which of course lots of people know, is to hire and fire the CEO and also other board members. Now, what that means is that a board not alone, but together with management, essentially is agreeing on the company's strategy, as I alluded to earlier, and then overseeing or making sure that management are tactically executing on that strategy. And the tactical execution of corporate strategy includes and touches lots of other areas. It includes and necessitates the monitoring of things like material enterprise risk, compensation, certainly of senior executives, allocation of capital, innovation roadmaps, financial statements, the culture of the company, etc. But again, important just to be really frank and put it in a way that there can't be any lack of clarity with respect to it. Takeaway number 2, and this is something where almost invariably when I talk to a CEO or a board and there's a real problem either with the board's perception of what they should be doing or the CEO's perception of what the board is doing, it invariably comes down to this. And it's an acronym that was created by a gentleman named John Nash. John Nash was the founder, I believe, of the National Association of Corporate Directors, NACD for short. And I think his acronym, I've always felt that his acronym is really elegant in explaining the difference very succinctly between operating a company, which is what management does, and overseeing the company, which is what boards do. NIFO stands for nose in, fingers out. Nose in, fingers out. And that really is the difference between operating and governance. Board members need to put their noses in order to make sure and oversee that management is executing on the corporate strategy on behalf of all the shareholders, but they need to undertake the same with their fingers out. They're overseeing, they're not running the company. Okay? Important, and again, something that I find that there's an awful lot of board members and CEOs, whether they're from the pre-IPO ecosystem or the public company ecosystem, that this really helps crystallize really what they should be doing. Takeaway number 3, this is really, I won't spend a lot of time on this, is really for, principally for earlier stage companies, because I get asked this all the time with some of the nascent companies that I advise that are definitely quite a bit before their IPO. But it's a fair question and it gets asked over and over and over again, which is when should I have a board? And the answer is definitely no later than the first round of outside capital. And look, there's lawyers and academics that go through this conversation over and over again. And sometimes you read it and you can read pages of this and you come away with, and you don't have an answer. And my feeling is that that's the best answer that I've heard and the one that makes the most sense, because I myself have been in an operating role in pre-IPO companies, and you definitely don't want to wait any later than the first round of outside capital to have an actual formal board. For those of you that want more information on this, the expert on the kind of startup aspects of governance, as well as being an expert on a scary number of things, is Brad Feld. Brad is a well-known VC, has written a lot of books, and he wrote a terrific book on startup boards that's available on Amazon. If you want more information on that, I highly recommend you read his book. So we talked a lot about so far about all the different corporate fact patterns, some of the things that people are focused on, not only industry titans, but institutional investors, shareholder activists, when it comes to looking at boardrooms. Well, one of the things that I get asked, probably the third most asked, is what's really the critical trait? What type of characteristics should I be looking for in my next board member, or even all of my board members? And I've heard, as I'm sure some of you on the phone have heard, I think probably most of the at least the reasonable answers to that question. Things like, you want people who are expert, you want people who have balanced personalities, you want people who are inquisitive, who are curious, you want people who play nicely with others, and by the way, all of those things matter. But in my mind, there is only one trait that absolutely every board member needs to have in order to be successful, and that's courage. And here's the reason why. Okay. Imagine that you're in a boardroom and it's 2006, okay? And one of the board members stands up and says the following: you know what, folks? I have heard lots and lots of discourse over the last few months about these derivative instruments. It strikes me that we are risking a company that has been around since 1850, that employs thousands of people, all of whom have their financial health wrapped up in our stock, none of the people on this board, to the best of my understanding, really understand these risks that we're trying to manage. These derivative instruments are so complicated that we can't even explain them to other people. So my question is either explain this to me again, or I have the following observation, which is what on earth are we doing? What on earth are we doing risking a company that's been around since 1850 on these hyper complex financial instruments that no one in this boardroom understands? Okay? Now, imagine if someone had stood up and had that conversation. Imagine if someone had stood up and had that conversation, not only in that company, but also in some other companies. So courage is really the most important characteristic in my experience. And when you point to lots of, and you look in kind of a post-mortem sense, I used that term earlier with Stanford's analysis of Lehman Brothers, when you look in a post-mortem sense, oftentimes what you find, you might find some of the smartest people you've ever met on a board. But if nobody raises their hand, and by the way, we'll talk about it in a minute, it's really hard to do. Really hard to stand up in front of a group of people who are also really smart and just raise your hand and say, you know what? I don't get it. I don't get it. Explain this to me again. It's hard. And that's the reason why one of the principal characteristics that you need in boardrooms ultimately is courage. This is absolutely the number one question I get asked, which is who should be on our board. And the reason they get asked that, of course, is because it's impossible to pick up any newspaper or watch any television, business television show without finding some investor commenting on how a board isn't properly comprised. So look, again, and I alluded to this a little earlier, and hence the terms that I used of trying to give frank, practical, implementable takeaways here, is that, boy, there's a lot written on board composition. There are some terrific materials, by the way, produced by some of the governance centers at big four audit firms. Law firms have some terrific content. But I guess I'll just say this as an observation. If that content was written in such a way that was really frank and practical and understandable and implementable, I wouldn't get asked this question over and over and over again. So I wanted to figure out a way to put this in a way that is as easily understandable as possible. And again, something that everybody can take away and remember for any board that they're on. And so, look, and where I've taken this from is really from the way that shareholder activists look at board composition. And I just want to be really clear here. There's an awful lot of people when I speak anywhere in the world that believe that because I'm a former institutional investor, that I believe that shareholder activism is terrific. You know, like anything in life, there are some shareholder activists that create an awful lot of value for shareholders, and then there's some that are reckless and awful. So I'm not a fan in any way, shape, or form of shareholder activism per se, but the way they look at board composition is, frankly, very helpful, and I think that a lot of them, especially the good ones, are right about this. So here's what they do when they look at a board. They say to themselves, look, these first three, let's call each one of these first three a bucket. So bucket number one is every company has a handful of key strategic imperatives, right? So we're going to write those down on the left side of the page. That's bucket number one. Bucket number two, every company also has some key impediments to achieving those strategic imperatives. That's going to be bucket number two. We'll write them on the left side of the page, right underneath the first bucket. And bucket number three is every company has some key target customers or some key industry verticals. We're going to also write those down on the left side of the page. And on the right side of the page, we're going to basically take all the board members that a given company has, and we're going to take all of their skills out of their proxy, or if it's a private company, out of their bio or their S1 filing, and we're going to put them down the right side of the page. And then we're literally going to draw, it's like a matching test. You know, 1, you draw a line down to F, 2 goes up to A, and where there's gaps, we're going to take the position that this board has some material gaps in it, and that gets down to, you know, again, use whatever nomenclature you want, but there's some board composition problems, okay? And then when you're done with that, then there's 4 and 5. 4 is, what skill sets do your key stakeholders think that your company is missing? So before you finalize who should be on your board or try and establish what kind of skills you think are missing, rather than doing it in a vacuum, which is ultimately value eroding, go out and talk to your stakeholders. And by the way, if you're going to go out and talk to them, you need to really actively listen to what they're going to say. And you might not necessarily do everything that they're suggesting, but you need to listen to them and take it under advisement. And the last thing is, and this is something that an awful lot of boards don't do, but definitely should do, certainly from the perspective of an institutional investor, is look at especially for public companies, mind you, look at the board composition of your competitors. Particularly, mind you, competitors that are outperforming you in your peer group. And look and see what their board composition looks like. You might find something that's very interesting that you haven't thought of in the exercise 1, 2, and 3, and moreover that your stakeholders haven't thought of. So that's really, from my perspective, the easiest possible, the most efficacious way, and again, in a practical, frank, implementable fashion, to talk about and decide amongst your peers who should be on your board. The second most question I get asked, and maybe not explicitly, but implicitly, is who shouldn't be on our board? And it's a great question. Easily the worst mistake, which we'll talk about in a minute, easily the worst mistake is for the CEO to put their friends and their family on the board. And the reason for that goes back to what we talked about earlier. And by the way, it goes back to what Larry Fink was talking about. Larry Fink, you might recall in that excerpt from BlackRock, was talking about the fact that board members need to engage in rigorous debate, was one of the words that he used, in order to make sure that corporate strategy is right. Well, look, all you have to do is think about being in a room with your friends and your family, and you know that it's pretty challenging sometimes to engage in rigorous debate with your friends. You don't want to make them look bad in front of others, and it's just something that it takes a rare person to engage in rigorous debate. And remember, in the context of a company, when the CEO puts somebody on their board, the CEO is ostensibly the leader of that company. And mind you also, there's compensation that goes along with that. You may get stock in the company, you may get a cash stipend. So the CEO is, if a CEO is in a position of putting or installing their friends on boards, that adds another layer that makes it even more unlikely that those friends are really going to engage not only in rigorous debate with each other, but with the CEO who put them there. And I already alluded to the second bullet point, but it's also really important to make sure that not all the board members are also friends, for the same reason that it's not great when all the board members are friends of the CEO. I'm going to go through a short case study in the last few minutes of the call this morning that elucidates a little bit more of this. But look, we talked a little bit about traits earlier, and the reverse the reverse of some of those traits is also true. You don't want people on your board who are either really dramatic or reactionary, people that need to hear themselves lecture others, people who are really thin-skinned, definitely not people who are disrespectful. Also, it's pretty important to make sure you're not putting people on the board that are pretty keen on the CEO's job. When it comes to particularly either smaller public companies or pre-IPO companies, another mistake that gets made often is the thinking that, gee, if only we had a CEO of a giant company who could be on our board, not only would it help with the credibility, but also, boy, this person has a giant bastion of information that could help us. Now, the latter is definitely true. They do have amazing experience, but what I have found, and lots of other institutional investors have found, is that it's actually quite challenging for people from Fortune 500, Fortune 1000 ecosystems to really integrate and acclimate and contribute to much smaller company environments. They're just different planets, and it can be really challenging. And the last is, for a reason we'll talk about in a minute, you definitely don't want people on your board who think that it's a job for life. When do you need new directors? Briefly, if you think back to the slide where we're talking about those three different buckets, the easiest way to decide when you need boards and why investors are constantly going on and on about board succession planning and making sure that people aren't staying on your boards for too long, from the perspective of an institutional investor and definitely an activist investor, and I know some of them and have listened to them talk about this, they have a really interesting perspective on it, which goes back to the way they look about composition to begin with, which is, hey, look, when any of those buckets that we put down the left side of the page, the strategic imperatives of the company, the impediments to achieving them, the key target markets or verticals that we're focused on, when those change, you need to look over on the other side of the page next to the board skill sets. And if you don't have skill sets that match those changes in your company, then you need to find a board member, a new board member that has that skill set, right? And so again, that's the reason why board seats are definitely not board seats for life. And by the way, in the pre-IPO ecosystem and in the small cap ecosystem, those three buckets that we talked about of the imperatives, the impediments, and the key stakeholders and target verticals, pardon me, what do we know about those? What we know about those is they change all the time, right? They change all the time. So if you're a company whose key strategic imperatives have changed a lot over your last few years, the chance that you still have board members who have the right skill sets to be overseeing and being able to engage in rigorous debate on those issues, going back to Larry Fink and to the discussion about Lehman Brothers, for example, the chance that you have those people, it may not be high, right? So when those things change, that's when board members need to change. So let me give you a very brief rendering of how this happens, because it's a lot to take in, but one of the things I find, particularly as an institutional investor, I've learned always through case studies, and people call them war stories. And what I've, in the very short case study that I'd like to take you through, first of all, the purpose of it is to really kind of see how these things happen in real life, how situations either evolve or devolve, as it were, when it pertains to boardrooms that either are composed right or not composed well. And what I've done here, I've learned over the course of time that you need to be careful about using hypotheticals where you have material non-public information, because smart people will back out the facts and figure out who you're talking about. So what I've done here is I've actually melded the facts together, which are all facts of particular patterns, but I've melded the facts together from a couple of different hypothetical, or a couple of different experiences, by the way, and put them together in order to create a case study, so that I'm not going back on anybody's confidentialities, and no one is going to be able to reverse engineer which company this was. But here's the fact pattern. Software company CEO, very experienced software company CEO. By the way, I'm going to use the word guy here probably a couple times. Unfortunately, it's the subject of a whole other discussion, but unfortunately in this situation, everyone who I'm talking about is a guy. The software company CEO, very experienced guy, had started and sold a number of other software companies. Couldn't find a smarter guy to run a software company. And what he was approaching his board with, and we'll talk about the board in a second, what he was approaching the board with was, hey, you know what, guys? What we need to do is we need to vertically integrate. Our software seems to be increasingly on this one hardware platform, and what I believe we should do is we should actually integrate, and we should buy a manufacturing facility in Asia, and we should begin not only owning the software piece, but also owning the hardware piece, so that we're now a device company instead of a software company. And there's a number of reasons why he thought that was a good idea. And again, CEO, very successful in software, no experience in hardware, definitely no experience in owning facilities or doing any material amount of business in Asia. What do we know about the board? The board was comprised of, and this is very common, by the way, the Series A, B, and C venture capital investors all had a board seat, and there was also a Fortune 1000 CEO. So there were 5 total board members, because the CEO was also on the board. The VCs and the Fortune 1000 CEO, really challenging to find 4 people with more sterling resumes than they did in the software industry. Loads of software industry experience. The CEO of the Fortune 1000 company did have some experience with doing business in Asia and also in the hardware industry. But here's a telling point, and this is also extremely common, is that the VCs had invested in the CEO's prior successful software companies at least 2 or 3 times. So not only were they friends with the CEO, but they had made money with the CEO, and moreover, they were all friends with each other. Also an extremely common fact pattern in Silicon Valley. So what happened? Well, here's kind of the step-by-step failure of this board, and it gets back to all the things that we've been talking about. The CEO came to the board with lots of materials, by the way, to explain over the course of a number of weeks, here's the reason why I think this is a terrific idea, and here's the plans, and here's the financials that go along with it, etc. Well, what the board did ostensibly in this particular case is exactly the opposite of what a great board that's really objective and proactive would have done. A great objective, proactive board would have taken all those materials, of course under advisement, taken them very seriously, but also gotten together on their own in the absence of the CEO and either brought in some industry experts to help them, because we're talking about an industry that they don't understand, which is hardware, in a country they don't have a lot of experience with, at least 3 out of the 4. And they would have done a lot of analysis of that independent of the CEO. That's what a great board would have done. But that's not what this board did. This board ostensibly nodded their heads in deference to the CEO. They certainly absorbed a lot of the materials, but they didn't do any of their any type of objective diligence on their own. Now, in fairness to this group, it should also be said that they've made a lot of money with the CEO. And again, that's one of the reasons why having board members that all know each other and also that are friends of CEOs, you're going to get deference or oversight light. You're not going to get actual rigorous objective oversight. And also, as I alluded to and we talked about with respect to some of the company fact patterns earlier, boards can't manage risks that they don't understand. 3 of the VCs literally had no experience whatsoever buying manufacturing facilities. They didn't know anything about hardware or experience in Asia. And again, the CEO of the Fortune 1000 company did. But number one, that guy's really busy running a Fortune 1000 company. Number two, it's also, in fairness to him, he has a team of 30 or 40 people when he goes and buys companies. So he assumes that all types of I's have been dotted and T's have been crossed, whereas in this company, there's 1 or 2 people that are really presiding over this acquisition. So it's unfair to expect too much more than this large company CEO did. But again, you're dealing with here 4 out of the 5 board members really didn't have the backgrounds at all to assess the risk that they were undertaking. So this wasn't really a CEO failure, and it's easy for reporters and others to just point the finger at the CEO and say this was a CEO failure. This was a board failure, right? This board was highly deferential. There was minimal debate about the acquisition, and once it was approved, I can tell you that there was a comedy of errors, frankly. Not only did they wildly overpay for the factory, there was taxes, there was a large tax bill for unpaid taxes before they acquired that facility. The margin benefits that they were looking for never materialized. There were all kinds of problems with this, and it made the ensuing life for the company really challenging, and unnecessarily so, by the way. So I get asked oftentimes, and when you think about that fact pattern, you think, well, what could the CEO have done differently in that fact pattern? What kind of role can a CEO play in a great board? And here's a couple of them. I won't go through all these, but here's a couple of them. Number one, when you look at companies that fail, one of the things that you see over and over and over again, you not only can see this, I have some people I went to law school with who are in the Justice Department who I've spoken to about this, also other institutional investors. When you look at companies that have failed, one of the things that you often find is you find that the tone at the top of the company was not what it should have been. And what I mean by that is, at a minimum, when you look in the middle management of the company, you'll find when you ask them that they weren't able to give bad news. They knew that they couldn't give bad news to any of the people they reported to because they would either be in trouble or sanctioned or maybe even fired. And so CEOs can help by creating a tone at the top where not only the CEO's team but also the board are not only welcoming but even solicitous of bad news. That's really important, and that's something where a CEO can have a big impact. The other thing that I'll point to here is that great boards spend time when they're talking about new strategies. They spend as much time talking about what failure looks like as what success looks like, and they try and use metrics to benchmark. Hey, if we're going to go to market with this new product, how are we going to know as a board if this fails? And let's talk about that, and let's reach some agreement about what failure looks like before we ever agree on a budget and agree on this new strategy. Why? Because that's how capital allocation problems happen, right? Which, by the way, is kind of the silent killer of pre-IPO and small cap companies, is the misallocation of capital, which oftentimes is in short supply. Capital allocation problems don't happen, or to put it in more lower elevation terms, you don't pour good money after bad when boards have carefully analyzed a new strategic initiative and agreed with management that if we get to this point, that's failure and it's game over for this new innovation piece of our innovation roadmap or our new strategy. When you don't benchmark failure, which, by the way, happens all the time in companies that don't have the right backgrounds to understand the strategy to begin with, and or situations where everybody's friends of the CEO or together. When you don't benchmark failure, that's how misallocations of capital happen. So we're coming up on the end of the hour. Just the last couple of takeaways here. And I think that in the pre-IPO ecosystem, just a couple of comments, and that is that certainly in the Sandhill Road ecosystem, the term I used earlier, real boards, have been kind of somewhat optional in the venture ecosystem, and board composition practices haven't changed meaningfully, as I alluded to earlier, since probably the 1970s. That's going to have to change, and it's going to change, and it's going to change pretty quickly here because of some of these well-known pre-IPO corporate governance failures, because investors that invest in venture capital firms, which are called limited partners, those limited partners are going to demand it. And I would suggest that it wouldn't be surprising if 4 or 5 years from now, every major venture capital firm had someone within the 4 walls of their company that had the title of head of corporate governance. And the last takeaway is, that shareholder activism, certainly in the small cap ecosystem, and this is important for those companies that are in the pre-IPO world and thinking of going public, the shareholder activism ecosystem in the small cap continuum is going to continue unabated as long as boards are not properly comprised, aren't objective, aren't proactive, and don't have courageous board members. This is not a phenomenon that's going to go away anytime soon. So my final admonition, I guess, is that CEOs who have this view, and this going back to the first image that we talked about an hour ago, CEOs who have this view of corporate governance, really what it comes down to, and really what we're talking about here, and the purpose of talking about some of these issues this morning, is that if you have this view of corporate governance, that it's kind of a form over substance waste of time, then when you listen to people like Warren Buffett and Jamie Dimon and Jeff Immelt and Larry Fink and Mary Barra, what you take away is there's an opposite of better governed companies make more money, right? The opposite is also true. And so CEOs who have this view of corporate governance are more likely to suffer financially, they're likely to innovate less, and they're likely to create fewer American jobs. And so that's really, in my mind, that's really the takeaway for this morning. I hope it's been helpful. I hope you have a great rest of the day. And again, feel free to be in touch with me by email or phone if you have any further questions. Thanks a lot.